doesn't it create an ironic, I guess maybe not so ironic, standoff between, like, if Davey, day trader, stands for the people, and you got the old wall, or affectionately, and the Fed, and your active managers with the fees on the other side, doesn't it create this interesting and inevitable collision between the two? If this stock market starts going down on the individual guy, then everybody's in bed at the same time together, and they're all pissed off.
Yeah, exactly. I think it does create that tension between them. So when my friend Ron Insana keeps saying that these day traders, it's going to end badly, Ron, you might be 100% right, but it's going to end badly for everybody. Is what it's going to end badly for. It's not going to be anybody else. And the other thing I find that's very interesting is when you listen to a lot of the active managers. Bill Miller was on a podcast recently, the Lake Mason manager, and he said that all of these Robinhood traders and the Davey day traders, he said they're trivial in the market. Well, a lot of these Robinhoods, they sell their order flow to these order execution firms, Citadel being one of the big ones. Citadel came out last week and said that retail orders now are somewhere between 20 and 25% of all of the trading on the New York Stock Exchange. It's a quarter of the trading. That's not insignificant. Now, maybe there's some institutional trading that's larger than that makes up the other 75%, but 25% is not insignificant in terms of what they're doing for these markets. They matter. They matter at the margin as well, too. So these people that keep wishing or hoping or jealous that they want this retail thing to end in tears, first of all, it's important. It's important at the margin, and second of all, if it does, it ends in tears for everybody. Yeah. And if Partnoy's message is you can do it without the suit doing it for you, it will create a lot of animosity. It won't end in tears with the expectation of me as Mr. Retail Trader, I will never do that again. I should hand my money to some high fee fund. I'll end with they screwed me, and I'm going to get even with them.
Yeah.
And that's the fear that we have with what's going on with this retail market. They're not going to just conclude that they're out of their league. They're going to conclude that somebody did it to them. And then we're going to have real problems on our hands then if that is what happens. So this is somewhat dangerous, what could be happening here in terms of these people wishing that this market would go down and wishing that Portnoy get his comeuppance. Because again, it hits everybody if that's what happens.
Well, then that's the grinder on the street. That's the American capitalist Portnoy, and I salute him for it. I mean, no offense to Ron Insana, but it ended in tears for him when he tried it on the buy side at SAC. And there's a lot of people that have institutionally not been able to make money for a long time. And guys, slide 4, just look at the flow of it all. And showing hedge fund AUM against passive ETFs, ETPs, ETFs fully loaded. The game has changed dramatically, and the game, if you're playing it like a hedge fund manager, like I was in the early 2000s, has changed big time. That's back. You used Steve Cohen back then. You got big block trading going on. People with big ideas at hedge funds, pushing around stocks, and it was all on fundamental research. I mean, that makes sense. But that game is gonzo. So if you say that prior to this, which is interesting with your number, prior to this, 80% of daily trading, as I'm sure you well know, 90% on some days with the higher volatility, was systematic trading. Quants, again, rules-based trading, not individuals. So if you take a big clip out of that and replace it with people are being talked down to as, oh, you don't know what you're doing. I mean, I'd equate like that to like playing in a men's league hockey game in the 6th division where people can't even skate. Like, I could die because I don't know what they're going to do. I don't know. A guy could come up to me and chop out my teeth and then step on my neck with his skates and probably do it by accident. But guess what? I'm dead and he's still playing. So it's an interesting thing. It's you gotta understand that it's dynamic and changing.
And keep in mind, going back to Insana, Portnoy got mad at him. It's a great anecdote. Portnoy got mad at him, and he pulled out a Scrabble bag one day and he shook up the letters and he pulled letters out to buy a stock, and he happened to pull out RTX, which is Raytheon, and he bought Raytheon stock, and I tweeted out at the time, I said, look, if he limits himself to 3 letters or less, he's going to be buying a New York Stock Exchange listed company that meets the qualifications for a New York Stock Exchange listing. So why is that any more irresponsible than buying spiders, which just buys the 500 largest stocks on the S&P? Is it really that much different? And I know that that's really upsetting to a lot of professional managers because it's true. It's really not that much different.
It's true.
And that has become the game that we've been that he is exposing. I still think that the reason he has become so popular and this thing has got the ire of everybody is because it is showing them in a light that they don't want to be showed at. And your last thought for you, you're right, that the game is over for a lot of these guys because in this world, you've got zero commissions. You can buy fractional shares. If you look at the platforms like Robinhood, the Teslas and the Amazons are booming. Well, there's a $3,000 stock in Amazon. Yeah, but you can buy a tenth of a share at $300
right. Yeah,
if you want to. Right, and now there's ETFs with zero fees or 1 or 2 basis points of fees. So if I've got $3,000 or $5,000, I can buy an ETF that maybe charges 1 basis point or 2 basis points of fees for no commission. And if I don't have enough money, I can buy a fractional share of it as well. So the old line high fee open-ended mutual fund and the old line high fee active manager, they're in a secular decline. They're not going to pull out. The only way they could pull out of this is if somehow they could do something that they've never done in their history, and that is actively show that they can beat the S&P 500, which as a group they can't. And so therefore, he is exposing that and asking, why wouldn't you do it this way? Why wouldn't you open an account, buy a handful of stocks you own, a couple of broad-based ETFs for no fees, no commissions, fractional shares if you don't have enough money, and just design it yourself and be done in 5 minutes on your phone, as opposed to the old style way. And it's the old style way managers that keep saying, this is going to end badly, this is going to end badly, like Leon Cooperman and stuff like that. Well, yeah, I think this is a different era, and he's just reflective of the era that we're in.
Yeah, 100%. I like Davey Day Trader. I have no ire for that guy. I think he's awesome. And again, if you don't like the game, go play a different game is the way I think about that. Let's just get
one last thought for you too on this. Every story I've read, every measure I've seen of all of these day traders is something else too to keep in mind. Most of them are actively, not everybody, but most of them are actively betting with money that they can afford to lose.
Right.
They treat it like gambling. So you know what that means? The prudent man rule is out the door. If I've got money I can't lose, it's like I'm in Vegas, right? You just get drunk and just go crazy and you have a good time. So this money is uber aggressive. So why does Hertz go from 1 to 6? Why are the airlines booming? The cruise ships are booming. Why did Tesla go up 80% in 2 weeks with the Robinhood crowd, kind of plowing 40,000 new accounts a day into it and stuff like that? Because they're betting with money they can't lose. And so therefore, even if they're 20-25% of the trading in the market, they're so aggressive with their turnover, their influence might even be bigger than that as well too. So I think one of the biggest mistakes professional managers make, maybe because they want it to be this way, is they say, oh no, this is trivial. It might be happening, but it's not very important. It is important. It's not the dominant factor, but it is important. And to dismiss it is to overlook an important aspect of the market today.